There's a signal flashing in the silver market right now that has only appeared one other time in modern financial history. And the last time it showed up, the last time this exact sequence of events lined up the way they're lining up today, silver didn't just go up. It didn't just have a good year. It exploded. It rewrote what people thought was possible for a metal that most of the world had spent decades ignoring. And I need you to understand something before we go any further. This isn't about charts. This isn't about some obscure technical pattern that only matters to traders sitting in front of three monitors at 5 in the morning. This is about something much deeper. This is about the monetary architecture of the entire world cracking at its foundation, the same way it cracked in 1973, and silver being the one asset that historically serves as the pressure gauge when that happens. So stay with me, because what I'm about to show you connects dots that most financial media isn't even close to connecting right now. And by the time we're done, you're going to see silver completely differently than you did when you clicked on this video. Let me start with a question. Do you know what actually happened in 1973? Not the surface level history lesson version, not the textbook paragraph about oil embargoes and Nixon. I mean what actually happened beneath the surface, in the mechanics of global money, because most people have the story almost completely backwards. Most people think 1973 was about oil. OPEC cutting supply, gas lines around the block, inflation spiking. And yes, all of that happened. But the oil crisis was a symptom. It wasn't the cause. The cause happened 2 years earlier, in August of 1971, when President Nixon walked into the White House briefing room and told the world that the United States was closing the gold window, that the dollar would no longer be redeemable for gold at any fixed rate, that the entire system the world had built its monetary order around since 1944, the Bretton Woods Agreement, was over. Now, think about what that actually means. For almost 30 years, every major currency on Earth was tied to the dollar, and the dollar was tied to gold. Gold was the anchor. Gold was the thing that said, this is real, this has value, this isn't going anywhere. And Nixon just cut the rope. By 1973, the world was beginning to fully process what that meant. The dollar was floating freely for the first time in modern history. Confidence in paper currency was evaporating. Nations that had held US dollars as their reserve were looking at each other across negotiating tables, asking the same uncomfortable question. If it's not backed by gold anymore, what exactly is it backed by? And into that vacuum, into that crisis of monetary confidence, silver and gold launched into one of the most explosive bull markets the precious metals world had ever seen. Silver went from under $2 an ounce in the early 1970s to nearly $50 by 1980. That's a move of over 2,000%. Gold did the same. Not because these metals are magic, but because when the monetary system loses its anchor, real things, things with weight, with history, with finite supply, become the refuge of last resort. Now, here's why I'm making this video today. Because right now, in the market, in the data, in the institutional flows, in the geopolitical architecture, that same signal is firing. Before I get into what that signal actually is and what it means for silver's price, let me just say this quickly. If you're watching this and you're a retiree or someone approaching retirement with real money in a 401k or IRA, I put together a free guide that goes through the specific saving strategies that thousands of American retirees are already using to protect their hard-earned wealth in environments exactly like this one. It's in the description below. It takes about 5 minutes to read, and it could change how you think about the next decade of your retirement. Check it out. Now, back to the signal. What happened in 1973 wasn't just a political event or a policy decision. It was a structural break, a point at which the rules that had governed global money for a generation simply ceased to apply. And what we are watching unfold right now, slowly, then suddenly, in the way that all major monetary transitions unfold, is another structural break, arguably a bigger one. Let me give you the data. Silver is trading right around $70 an ounce right now. That sounds like a big number. And it is a big number compared to where silver was just a couple of years ago. But when you understand what's driving it, when you see the full picture, $70 starts to look like the beginning of the move, not the end of it. Start with the gold to silver ratio. This is one of the most important and most overlooked metrics in precious metals. It simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, going back thousands of years, back to ancient Rome, back to the ratio that existed in the natural crust of the earth, Silver and gold occur at roughly a 15-to-1 ratio. 15 ounces of silver for every 1 ounce of gold. That's the geological reality. That's what nature says these metals are worth relative to each other. In the modern era, the ratio has averaged somewhere between 50 and 60 to 1. And in 2020, at the height of pandemic panic, it briefly spiked to 120 to 1. 120 ounces of silver to buy 1 ounce of gold. That was a historic extreme, an anomaly, a rubber band stretched to a breaking point. That rubber band has been snapping back, and when it fully normalizes, even to the modern average, let alone the historical average, the math on silver's price becomes extraordinary. This is part of what's driving institutional money into the silver market right now. Not speculation, arbitrage. Cold, mechanical, profit-seeking arbitrage on one of the most stretched valuations in modern commodity history. But the ratio story is just the appetizer. The main course is the industrial demand picture. And this is where things get genuinely fascinating, because silver is not just a monetary metal anymore. It hasn't been for a long time. Silver sits at the intersection of two of the most powerful technological megatrends of our generation: the electrification of everything and the build-out of renewable energy. Here's a number that should stop you in your tracks. A single solar panel requires approximately 20 grams of silver. That sounds small, but when you scale it across the solar installation targets that governments around the world have committed to, when you understand that solar capacity installations globally are growing exponentially, the silver demand math becomes almost incomprehensible. We are talking about hundreds of millions of solar panels needing to be manufactured, each one requiring silver. Silver that has to be mined, refined, and delivered to manufacturers at exactly the moment when mining supply is structurally constrained. New silver mines take years, sometimes over a decade, to bring into production. You can't just turn on a switch when demand specs. The supply response is slow, expensive, and uncertain. And solar is just one piece. Electric vehicles require silver in their charging systems, their electronics, their battery management systems. The 5G infrastructure build-out requires silver in its conductivity applications. Medical technology, semiconductors, water purification. Silver is the most electrically conductive metal on Earth, and the modern economy is becoming more electrical every single day. What this means is that silver is experiencing something it has never experienced before in its entire monetary and industrial history. It's being pulled simultaneously by investment demand, people and institutions wanting it as a monetary hedge, the way they've always wanted it, and by industrial demand that is growing faster than mining supply can possibly respond to. These two demand forces are compounding on each other at the exact moment when the monetary system is showing cracks that remind seasoned observers of 1973. Now let me bring in the institutional angle, because this is where the story gets particularly interesting. For the last several years, central banks around the world have been doing something extraordinary. They have been buying gold at the fastest pace recorded in modern history. China, Russia, India, Poland, Turkey, Saudi Arabia, central bank after central bank has been quietly, methodically moving their reserve assets away from the dollar and into physical gold. The numbers are staggering. Multiple consecutive years of record or near record central bank gold purchases. Now, why does this matter for silver? Because central banks are not buying silver, they buy gold. But what central bank buying tells you, the signal it sends, is that the most sophisticated, best-informed institutional actors on the planet are losing confidence in the current monetary order. They are repositioning. And when central banks move, private institutional capital follows. And when institutional capital moves into hard assets broadly, silver captures a disproportionate upside because its market is so much smaller than gold's. A relatively small amount of institutional money flowing into silver moves the price dramatically. We're already starting to see it in the COMEX data. The commercial short position in silver, which for decades was one of the most heavily shorted markets on the planet, with large bullion banks holding massive short positions that effectively served as a ceiling on the price, that position has been undergoing structural change. The mechanics of how silver is traded on the COMEX, the relationship between paper silver and physical silver, the dynamics that allowed a tiny group of large financial institutions to effectively manage silver's price for decades, those mechanics are under pressure in ways they haven't been in 50 years. This is part of what the 1973 signal actually refers to. Because in 1973, what triggered the explosive silver move wasn't just policy. It wasn't just the end of Bretton Woods. It was that the mechanisms the establishment had used to suppress and manage precious metals prices broke down under the weight of real world demand and real world loss of confidence. The rubber band snapped, and when it snapped violently. Consider the Hunt brothers story, because it illustrates this dynamic better than any chart could. In the late 1970s, two Texas oil billionaires, Nelson Bunker Hunt and William Herbert Hunt, became convinced that the dollar was finished, that inflation would continue accelerating, that silver was the only true store of value in a world where paper currencies were being debased at an unprecedented rate. So they started buying silver, and they kept buying and buying. They accumulated somewhere in the neighborhood of 200 million ounces of physical silver, an almost unimaginable quantity. They cornered a significant portion of the world's available supply. Now, most people tell the Hunt brothers story as a cautionary tale about greed and overreach, and there is truth in that. But here's what most people miss. The Hunts were ultimately right about the macro thesis. They were right that inflation was destroying purchasing power. They were right that silver had been suppressed. They were right that the monetary system was broken. What they got wrong was leverage, timing, and concentration. The COMEX changed the margin rules specifically to stop them, a naked manipulation of the rules mid-game to protect the existing financial establishment. Silver crashed from nearly $50 back down, but the underlying reality the Hunts identified didn't go away. It just got deferred. What's fascinating, and what should make every silver watcher's ears perk up, is that the conditions the Hunts identified in the late 1970s are present again, in many ways more extreme. Monetary debasement is more advanced. Global debt levels make the 1970s look fiscally conservative. The de-dollarization trend that was just beginning in the 1970s is now an explicit policy goal of a coalition of nations representing a significant portion of the world's population and economic output. The BRICS bloc, Brazil, Russia, India, China, South Africa, plus the expanding roster of nations now seeking membership or closer alignment, represents a deliberate, coordinated effort to construct an alternative to the dollar-denominated financial system. They are talking openly about commodity-backed trade settlement, about bypassing SWIFT, about reducing their dependence on U.S. financial infrastructure. This isn't conspiracy theory. This is stated policy. This is what heads of state are saying in official communiques, and silver sits right in the middle of that story. Because silver, like gold, is a commodity that transcends the dollar system. It has value in yuan, in rupees, in rubles, in any currency you want to price it in. And as the world builds alternative financial infrastructure, the monetary metals become more relevant, not less. Here's where I want to bring this home for you in a way that's personally meaningful, because everything I've described so far is geopolitical, macro level, big picture. But the real question is, what does this mean for regular people? For people who worked for 30 or 40 years, built up savings, have a retirement account they're depending on, and are now watching an inflation rate that has eaten into their purchasing power while the financial system tells them everything is fine. You know the feeling. You go to the grocery store and something that cost $2 a few years ago is $3.50 now. You look at what your 401k would actually buy in real terms, not in nominal dollar numbers, but in actual goods and services, and it's less than it was. The numbers in your account might look bigger, but the purchasing power behind those numbers has eroded. That's not an accident. That's the system working exactly as designed. Here's a quick aside that I think is genuinely worth your time. If you have $100,000 or more sitting in a traditional IRA or 401k, there is a way to get physical gold into a tax-advantaged retirement account without triggering penalties or a taxable event. It's called a gold IRA, and it's something the mainstream financial industry doesn't talk about much because they don't make commissions on it. But for people who are serious about protecting the real purchasing power of their retirement savings, not just the nominal dollar amount, against the kind of monetary disruption we've been discussing today, it's worth understanding. I've got more on that in the description, and I'll circle back to it at the end of this video for those of you who are still with me. Because what I'm about to tell you about where silver goes from here is the part that ties everything together. Let me talk about the supply picture more specifically, because the demand side of this story, the industrial demand, the monetary demand, the institutional demand, is extraordinary. But the supply side is the accelerant. Silver mining is genuinely difficult and genuinely constrained. Unlike gold, which is mined predominantly as a primary product, companies that go out specifically to find and mine gold, Approximately 60 to 70% of silver production comes as a byproduct of mining other metals. Copper mines, zinc mines, lead mines, silver comes out as a secondary product. What this means is that silver supply is not primarily responsive to silver's price. If silver goes to $150 and copper stays flat, the major copper miners don't suddenly change their production plans. They continue mining copper, and silver continues to come out as a byproduct at roughly the same rate. This is profoundly different from most commodities, and it creates a structural supply rigidity that makes silver uniquely vulnerable, or depending on your perspective, uniquely attractive, to demand shocks. Now pair that with this. The above-ground stockpiles of silver that are actually available for immediate delivery and investment purposes have been declining. Unlike gold, where virtually all the gold ever mined still exists somewhere in the form of jewelry, coins, bars, central bank reserves, silver has been consumed, used up. The silver in your iPhone, the silver in a solar panel, the silver in medical equipment, it doesn't come back in any economically practical sense. It goes into landfills or disperses into the environment at quantities too small to recover. Silver is being eaten by the industrial economy faster than it's being mined. There have been estimates from credible analysts, not fringe voices, people with serious institutional credentials, suggesting that at current and projected depletion rates, the above-ground silver available for investment and industrial use could become genuinely scarce within this decade. Not just expensive, scarce, as in not available at any price because the physical inventory simply isn't there. Think about what that means for pricing dynamics. When a commodity becomes physically scarce, not just paper market scarce, not just futures contract scarce, but physically unavailable, the price mechanism that normally operates gets replaced by something more primal. Bidding wars, industrial users paying whatever it takes because the alternative is shutting down production lines. Investment demand overwhelming available supply. The silver market is relatively small. The total value of all above-ground investment silver is a fraction of the gold market, which is itself a fraction of global bond and equity markets. A very small redirection of institutional capital, a tiny slice of the money managed by sovereign wealth funds, pension funds, family offices, insurance companies, into physical silver would overwhelm the market. Let's talk about what 1973 actually looked like in real time, because I think there's something important in the texture of how these monetary transitions unfold that the charts don't fully capture. In 1973, most people didn't realize what was happening. That sounds strange in retrospect, given what we know now, but monetary transitions are inherently confusing in real time. The signals are there: inflation rising, dollar weakening, geopolitical uncertainty, commodity prices climbing. But the narrative being offered by the financial establishment was always reassurance, always an explanation for why this was temporary, always a reason why the fundamentals were sound and panic was unwarranted. The people who recognized what was happening in 1973 and positioned accordingly, who bought silver and gold when they were still in the early stages of their bull market, before the general public had connected the dots, those people experienced returns that fundamentally changed their financial lives. The people who waited for consensus, who waited for their financial advisor or the evening news to confirm the thesis, bought in near the top in 1979 and 1980 and got hurt. The same dynamic plays out every single time. The information is available. The signals are clear to anyone who looks at them with intellectual honesty. But acting on that information requires going against the reassuring noise of the mainstream narrative, and most people find that psychologically very difficult. Consider the specific mechanics of what's happening in the silver market right now on the institutional side. The ETFs, specifically the large silver ETFs, have been experiencing sustained inflows. These aren't retail day traders buying in and out. These are long-duration institutional allocations. Pension funds and family offices that measure their investment horizon in years and decades are adding silver exposure. At the same time, the spread between paper silver, the price of silver futures contracts and ETF shares, and physical silver, the actual cost of taking delivery of real metal, has been widening in ways that historically precede significant price moves. When it becomes expensive and difficult to convert a paper silver claim into actual physical metal, that's telling you something important about the real supply and demand dynamics that the paper market isn't yet fully reflecting. We saw a preview of this dynamic during the retail silver buying surge a few years ago, when ordinary people tried to buy physical silver en masse, and dealers across the country ran out of stock, while the paper price showed little movement. The paper market and the physical market were disconnected. That disconnection was temporary then, What we're seeing now has a more structural character. And here's something that almost nobody is talking about, but that I think is one of the most important dynamics in the silver market right now: China. Not as a geopolitical adversary, not in the context of trade wars or military tensions, but as the world's largest industrial economy, with the world's most aggressive green energy build-out. China is simultaneously the world's largest producer of silver and the world's largest consumer of silver. And the domestic demand from China's solar installation program, which is on a trajectory that makes other countries' green energy ambitions look modest by comparison, is consuming an extraordinary amount of that domestic production, which means less Chinese silver reaching global export markets, which means global supply outside of China is tighter than the headline production numbers suggest. Now add to that the broader geopolitical climate, trade tensions between major economic blocs, tariffs and trade restrictions creating commodity flow disruptions, supply chains that were already complicated becoming more complicated. The idea that you can simply route commodities around geopolitical friction without price consequences is something that the events of the last several years have pretty thoroughly disproven. Silver is not immune to this. Silver is caught in it. And for an asset whose supply is already structurally constrained and whose demand is accelerating from multiple independent directions simultaneously, geopolitical friction is an amplifier, not a dampener. Let me bring in one more historical layer, because I think it completes the picture in an important way. The 1980 peak in silver, that extraordinary move from under $2 to nearly 50, happened in the context of an interest rate environment that was fundamentally different from anything we've seen in the modern era. Paul Volcker at the Federal Reserve was raising rates aggressively, ultimately pushing them above 20% to break the inflationary cycle. The conventional wisdom, the textbook answer that every financial advisor and economics professor will give you, is that higher interest rates are bad for gold and silver because precious metals pay no yield. But here's what that textbook answer gets wrong. It looks at the nominal interest rate. What matters for gold and silver is the real interest rate, the nominal rate minus inflation. And there are periods where, even with very high nominal rates, the real rate remains negative because inflation is running faster than rates can chase it. In those environments, negative real rate environments, gold and silver have historically performed extraordinarily well, regardless of what nominal rates are doing. And the current global debt situation creates an almost impossible bind for central banks. The total debt load at the government level in most major economies is so large that genuinely high real interest rates would cause catastrophic debt service costs. The math of returning to aggressively positive real rates in an environment of current debt levels just doesn't work without triggering a debt crisis, which means that financial repression, maintaining rates below the real inflation rate, gradually inflating away the debt, is essentially the only politically viable path forward. And financial repression is historically the single most bullish environment for monetary metals. It's the environment where governments are slowly, deliberately stealing purchasing power from savers to manage their debt burden. And gold and silver are the instruments that savers use to resist that theft. This is why I keep coming back to the 1973 parallel, because 1973 wasn't just about oil. It was about a government that had made financial commitments it couldn't keep, that chose inflation over default, that broke the rules the monetary system had been built on, and precious metals were the verdict that the market rendered on that choice. The parallels today are not perfect. They never are. History rhymes. It doesn't repeat exactly. But the structure of the situation, the monetary commitments that can't be kept, the debt levels that only work under financial repression, the geopolitical realignment away from dollar dominance, the supply constraints meeting explosive demand, that structure is more reminiscent of 1973 than any other moment in modern financial history. And silver, not gold, silver, tends to be the more explosive response. Because silver is smaller. Because silver carries both the monetary story and the industrial story simultaneously. Because when institutional money moves into silver, there isn't a lot of silver for it to go into. The math of a small market meeting large flows is the math of extraordinary price moves. For people watching this who are in or approaching retirement, people who've spent decades building wealth and are now trying to figure out how to protect it in an environment this uncertain, this volatile, this genuinely unprecedented in certain respects, I want to say this directly. The purpose of understanding everything we've discussed today is not to make you panic. It's to give you the information you need to make clear-eyed, well-grounded decisions about your financial situation. The history is unambiguous that in periods of monetary disruption, in periods when the financial establishment is managing an impossible situation through inflation and currency debasement, people who hold real assets, real money with a 5,000-year track record of preserving purchasing power, fare dramatically better than people who hold paper promises. That's not a radical or fringe view. That's the lesson of every major monetary transition in history.